Hi there, welcome back. In this video I'm going to explain one of the very important financial statements under IFRS. That is gonna be International Financial Reporting Standards 7, the Statement of Cash Flows. As you are aware that there are four main financial statements in financial reporting. These are the Statement of Financial Position, the Statement of Profit or Loss and Other Comprehensive Income, the Statement of Changes in Equity, and the last one is the Statement of Cash Flows, which I'm gonna talk about it in this video. So what is the function of cash flows statement? Well, firstly, it requires entities to present the change in cash and cash equivalents in the form of statement of cash flows. Secondly, it explains the elements of cash and cash equivalents and their cash movement. Thirdly, it prescribes the cash flows as either operating, investing or financing activities. Lastly but not least, it provides two methods in reporting of operating activities, direct and indirect method. If you think this video could help you learn something new, please subscribe to my YouTube channel now, and share the video with your friends, to spread knowledge. The form of cash flows statement comprises three main activities sections. The first section on the top is operating activities. Under operating activities you reflect the performance of entity during the financial year or period. So let us see the form of the cash flows statement under IFRS. As I mentioned earlier, there are three main sections in the cash flows statement form. However, on the top, you need to state reporting entities information, such as the entity's name, address, reporting period, and reporting currency. Then, the first section is the operating activities section. There are two methods, the direct and indirect method. However, practically speaking, the indirect method is the common one, where you start by extracting net profit or loss, for both reporting periods and comparative figures. The elements of cash in under operating activities are sales of goods or rendering services. Another source of cash in could be from royalties, fees, or commission that an entity would generate from operation. On the other hand, the elements of cash out under operating activities either to be paid to supplier in the form of purchasing goods or receiving services, and paying salaries to the employees of an entity. As I mentioned earlier, under the indirect method, you should extract net profit or loss from the statement of profit or loss. Then start adjusting non-cash elements, such as depreciation, amortization, and provisions. All these non-cash elements must be added back. If there were any finance costs you need to add, on the other hand, investment income and profit on disposal of fixed assets should be deducted. In addition to these, we need to consider capital working, which you consider an increase or decrease in inventory, trade receivables due from related parties, and other receivables. These are calculated by previous year figures from the Statement of Financial Position, minus current year figures from the Statement of Financial Position 2. Also, we do have an increase or decrease in trade payables due to related parties, and other payables. These are calculated by current year figures from the Statement of Financial Position, minus comparative year figures. Note, if there is no comparative year or period, you should consider it at zero. The result would be either cash from, or cash used in operations. Then you should deduct any income tax or interest paid, in order to reach net cash from, or net cash used in operating activities. The section of cash flows statement is investing activities. Under the investing activities, an entity is required to show long-term economic benefits transactions, such as acquisition of property, plant and equipment and intangible assets. Under investing activities, you should deduct any payment to buy a fixed asset. On the other hand, an entity might dispose, or scrap some of its previously acquired fixed items. The gain from the disposal of these items should be added. Another probability under investing activities is equity and debt instruments. Imagine dividends are received, so this would be cash in and increase net cash and cash equivalents. Also, we need to consider any advances and loans to other parties. If a company gives long-term loans, or advance to its related parties or staff, it will decrease cash and should be cash out. But be careful, if these activities are part of your day-to-day business activities, you should show them under operating activities. Exactly what is happening in the financial institutions? Take an example of banking industry is financing activities. This section contains rights or obligations of shareholders of entity. This could be in the form of issue of shares and equity instruments, any sort of loans, notes and bonds received in course of financing activities. The closing balance of cash and cash equivalents, showing in the statement of financial position at reporting date, must match to the net cash at the end of year or period.